Hi, hello everybody, and welcome to the corporate tax session taken from the most recent series of finance director seminars held in November. So welcome along. In this session, we're going to pick up on corporate tax and cover off some main points that have arisen in terms of both in general, plus also in connection with the most recent budget at the end of October. So what we're going to cover in this section is have a look at what HMRC are up to, have a chat about corporate governance, talk about the corporate tax roadmap that was published in the budget I've just referred to, talk specifically about one particular tax measure, the corporate interest restriction rules, and then finish off by going back to a very hot topic from the last budget, employers' national insurance. So without further ado, let's go into life with HMRC. As many of you will have read about in the press, HMRC are very keen to close the tax gap, and the budget announced additional funding for HMRC with a view to try and recruit 5,000 additional compliance staff by the end of the year 29-30. So far, they've recruited around 450 additional tax inspectors, people who are looking at companies and individuals' compliance records. Now, being honest, I think the idea of trying to get 5,000 new compliance staff, having them trained up and undertaking compliance checks on taxpayers' records by the end of this decade is a big ask, given the number of people leaving HMRC and already existing problems HMRC have in undertaking their current workloads without looking for additional things to do. But this tax gap is clearly something that the government wants to do something about, in particularly where that tax gap relates to smaller and medium-sized businesses or sole traders, where HMRC estimate that the unpaid tax from those people, those businesses, is around £24 billion. Now, I know from my experience that there will be things that go wrong in compliance amongst that size of business, but also the complexity of the tax regime is a big reason for mistakes being made, sometimes very genuine and innocent mistakes being made. The other thing I would say is that on the additional resourcing that's been announced, it will still be a question of process tax returns first and then ask questions later. And what this means is it could be a considerable period of time that goes by from filing your tax returns to receiving an inquiry from HMRC. So the need to keep good records, to remember why it is you did what you did, why you filed a particular position, working with your advisors is fundamentally important. I think the other thing I would just say is that the HMRC are going to raise the number of investigations that they do undertake over this next sort of 4 or 5 year period. And what I'd encourage everybody listening to this call to do is consider taking out tax investigation fees insurance. It's something Francis Clark offers. It's certainly something you should be considering should you be unfortunate enough to be amongst those companies that are subject to inquiry from HMRC. The next point I wanted to raise, again referring back to the budget, was the increase in late payment interest rate charged by HMRC, and this has gone up by a whopping 1.5%. It now sits at 9%, which is a heck of a rate of interest to be paid on unpaid tax liabilities. And again, it's resulted in the gap between what they charge on late payments of tax and what they pay on overpaid tax to grow even wider. The gap between the two is now over 4%. So it's important that you pay the right amount of tax at the right time if you're to avoid this very, very heavy penal interest rate charge. For those of you who are in the quarterly instalment payment regime, QIPs, this is particularly difficult because we already know it's quite hard to estimate what your tax is going to be for those instalment payments. And I've heard companies saying that they're going to err on the cautious side of potentially overpaying slightly rather than being hit by that very high rate of interest. Again, that's a commercial decision for you to consider. But bear in mind that if you do underpay on those instalments, you are going to be hit by this large percentage increase in interest on late paid tax, including on quarterly instalment payments. And again, the key is trying to estimate your liabilities as accurately as you can in order to avoid interest being charged on tax. I suppose my overarching message on this slide before we move forward is to ensure that your business has robust tax risk governance and controls to prevent inquiry activity and to make sure that you're meeting your liabilities as and when they fall due. So I want to move on now and talk about corporate governance. The first two measures, Senior Accounting Officer and the publication of a tax strategy, they do refer to very large companies, those with a turnover of more than 200 million a year, or with a balance sheet with a value of £2 billion. So I accept this isn't going to apply to a lot of companies in our neck of the woods. But all the same, these are important things to ensure that you're complying with when you do start approaching those turnover thresholds, or indeed are already over them. The Senior Accounting Officer rules is a question of appointing somebody within the company who will act as the Senior Accounting Officer. It's worth stressing that this cannot be your tax agent or tax advisor. It has to be somebody on the company's payroll. And this person is appointed in order to certify each year to HMRC that the company has got robust procedures in place to ensure it complies with the tax codes that are in existence, that it takes appropriate steps to ensure that it's meeting its obligations to file on time, that it's thinking about its tax profile, its risk profile, and that there are internal checks and balances to ensure that it can't fall foul of the tax regimes in terms of law and practice. And similarly so, the publication of a tax strategy, this is about ensuring that where a company is within the scope of the tax strategy publication rules, it has something on its website setting out what steps it takes to ensure it meets compliance obligations, that it's a good tax citizen. Now, there are penalties that apply if the certification required for the SAO regime isn't met with, £5,000 a year, and a failure to publish the tax strategy brings in a penalty of £7,500. I think the fact is, though, and as I say, these things should apply only to very large companies. But what we're seeing at Francis Clark is an increasing trend for companies that may be going to market, maybe thinking about selling up and moving on. When due diligence is undertaken on their tax profile, a lot of buyers can be thinking about, well, is this target company, is this company a good tax citizen? What is it saying to its client base, its customer base, its supply chain, and to its employees about its approach to taxation? So even though an in particular publication of tax strategy only applies to very, very large companies, sometimes it can be worth considering having something on your website just to highlight just what a good tax citizen you are. The corporate criminal offence applies to all companies, and this is a regime that was introduced a few years ago now, whereby companies have to be able to say that they are not in any way, shape or form facilitating tax evasion. Now, it should be blindingly obvious as to when people are perhaps dealing with suppliers who want to invoice in a certain way, that you should be extraordinarily wary and avoid, like the plague, getting involved with those sorts of entities. But sometimes it can be hard to know when you might be straying into dangerous waters. For example, when it comes to things like using umbrella companies. And I think we'll see a greater use of umbrella companies when it comes to the provision of a workforce with the increase in national insurance rates. You have to consider whether the supplier of labour, those umbrella companies, are legitimate themselves. If they're not, you could be held responsible, accountable, and suffer financial penalties, criminal offence that this is, as a result of not doing your due diligence on who might be supplying resources to you where there is a tax element involved. The final point on this slide, again, might affect perhaps larger companies more so than small and medium-sized entities, relates to uncertain tax treatments. This applies where a transaction is involving over £5 million of pay-as-you-earn corporation tax or VAT, where the position that you might be adopting is at odds with perhaps stated HMRC policy and guidance, or where perhaps there has been case law that sets out an approach that is contrary to the one that you're undertaking. Where you are undertaking uncertain tax treatments of that nature, you have to notify those in advance to HMRC so that they can be fully considered. Moving on, I want to return back to the budget on the 30th of October, and a lot of people, ourselves included, were delighted that the government published a corporate tax roadmap. This document committed the government to capping the main rate of corporation tax at its current level of 25% for the remainder of this Parliament, and also maintaining the small profits rate of 19% and the marginal relief between the two for the remainder of this Parliament as well. In addition, the current capital expenditure reliefs, first-year allowances, full expensing allowances for capital expenditure on qualifying plant and machinery, they're also being maintained, as well as the, current research and development regime. I mean, it did just change in 2024, but the regime that we have now that was changed in 2024, that will stay in its present form for the remainder of this Parliament, as will the patent box scheme, the regime whereby profits that are derived from the exploitation of patents are taxed at a reduced rate of 10%. The intangible fixed asset regime is also going to be maintained in its current form, and that relates to intangible assets that are purchased and on your balance sheet, relief being claimed on those, as is currently the way under existing law. I just add two further comments though. First of all, this is a corporate tax roadmap, and we were disappointed that it was only corporation tax that really was touched on this roadmap. It would have been good to see business tax as a whole included, covering things like VAT and business rates as well. And secondly, I think the fact is that, as you may have seen on earlier segments of this collective group of presentations for the finance directors seminars, it looks like the government is still going to face a shortfall, even on current spending plans, of some £9 billion during this Parliament. And so whilst I welcome the commitment that's been made to maintaining the current corporate tax regime, we can't be unsurprised if things do change during the life of this Parliament. However, without being too churlish, every company I speak to always says that stability and certainty is what people look for when it comes to corporation tax more than anything else, and so we must welcome this commitment to stability in the corporation tax environments at the present time. I mentioned at the beginning that I wanted to touch on one specific segment of the Corporation Taxes Act, and this relates to the corporate interest restriction rules. Now, these apply where a company has interest and financing costs of over £2 million, and where that is the case, such a company has to nominate a company to make reports to HMRC within its group structure, or if that's a standalone company, obviously it would be that company that would be the reporting company. And the company has a 12-month deadline within which to file its returns under the corporate interest restriction rules. Essentially, where more than £2 million of interest or finance costs has been incurred, a restriction applies, and the excess amount over that £2 million threshold has to be, the disallowed element has to be allocated against the companies in the UK group. But why am I mentioning this on this call? Well, interest rates have been quite high of late, and it's therefore the case that interest and financing costs, particularly where perhaps there have been large capital infrastructure, capital spend projects being undertaken, or perhaps acquisitions of other companies have been made, that your interest costs could be heading towards that £2 million threshold. we're seeing increasingly it doesn't take an awful lot to start pushing towards that £2 million, and therefore entering this aspect of the corporation tax's rules, and having to comply with these filing requirements. But I'd also say that at the moment, if you're not over £2 million, or perhaps not even really that close at the moment, it might still be worth making a voluntary return, because by doing so, you get the chance to bank the excess interest relief between what you actually incurred and that £2 million, and carry forward that allowance for up to 5 years. So if you don't have an interest restriction now, but you might end up having a restriction in future years, by making a voluntary return now, you can capture that excess interest relief and carry it forward for the periods when you might be over that £2 million threshold. It's certainly one that you should be discussing with your advisors, and your advisors should be discussing with you. Finally, on this section relating to corporation tax matters, I want to return to the employer's national insurance increases. As has been mentioned elsewhere, the threshold has been reduced to £5,000 from April, and the rate itself has risen to 15%. Okay, the employment allowance per employer has been increased more than doubled, but actually where you've got lots of employees, that's not going to make a big difference given the massive increase in national insurance that's been imposed, £615 per employee. But it would be worth just mentioning that you mustn't forget that apprentices under the age of 25 and all employees under the age of 21, there is no employer's national insurance at all on their wages until they get to the upper earnings threshold, which is in excess of £50,000. So the question is, what can you do to mitigate these increases in national insurance? Well, I want to go back to an old favourite of salary sacrifice. So this is a system where you can mitigate national insurance generally, and obviously these increases specifically, where in consideration for an employee sacrificing part of their salary, instead they take benefits that avoid national insurance. And the slide sets out some popular ones, for example, pension contributions, electric vehicles, and the cycle to work scheme. But like most reliefs, it's really important to go through the process of implementing a salary sacrifice scheme sensibly, properly, thoroughly. So first of all, you need to consider what opportunities you might have to put in place a salary sacrifice scheme, what the process is going to be, how long it will take to put it in place, and are there any risks? And very briefly, and I appreciate this slide is quite busy, and as I mentioned, the employee gives up an amount of salary via contractual change in their terms of employment in return for an employer-provided benefit. Tax and national insurance savings occur as the benefits exempt from lower tax and a national insurance charge than the amount that would have been paid on the salary that's being given up. I've been over what benefits the scheme covers, but again, going back to that process thing, what you will need help with is with the scheme design, the documentation that needs to be drawn up and pulled together, communicating with your employees, updating your HR processes, and ensuring that pay slips give a clear picture of the salary that's being foregone and what's being received by way of salary sacrifice. It's also important to get clearance in advance from HMRC, and that is something obviously we can help you with too. So in conclusion, salary sacrifice schemes are still available. They are attractive and they represent no cost to the employer. In fact, as I've mentioned, you, the employer, saves employers' national insurance as well. And I think with those increases in national insurance, salary sacrifice is something you should look at actively with a view to seeing what you can do to mitigate those increased business costs. So that's a quick canter through corporation tax aspects from both the budget and in general. And all that remains for me to do is to say thank you very much indeed for listening to this segment and wish you all the best. Thank you.